Investing for beginners, a vital skill. Investing is one of the most important things you can do to secure your financial future. It allows you to grow your money over time and reach your financial goals. For beginners, understanding the basics of investing can seem daunting, but it's crucial to start early and learn the fundamentals. This episode will guide you through two popular investment options: index funds and stocks. We'll break down the complexities of each, compare their risks and potential returns, and help you determine the best approach for your investment journey. Remember, investing is a marathon, not a sprint. By starting small and making informed decisions, you can pave the way for a secure and prosperous financial future. Understanding the basics: stocks and index funds. Before diving into the intricacies of investing, let's clarify what stocks and index funds are. A stock represents a small ownership piece of a company. When you buy a stock, you're essentially buying a tiny slice of that company's ownership, hoping its value will increase over time. An index fund, on the other hand, is like a basket of stocks. It tracks a specific market index, such as the S&P 500, which comprises 500 of the largest publicly traded companies in the U.S. When you invest in an index fund, you're investing in a diversified portfolio of stocks representing that index. Understanding the fundamental difference between these two investment vehicles is crucial for making informed investment decisions. Risk and volatility. Steady growth versus potential swings. Investing always involves some level of risk, but understanding the difference in risk profiles between stocks and index funds is key. Individual stocks can be highly volatile. Their prices can fluctuate significantly in the short term, influenced by factors like company performance, industry trends, and overall market sentiment. This volatility makes stocks a higher risk investment, especially for beginners. Index funds, due to their diversified nature, tend to be less volatile. Since they track a basket of stocks, the impact of a single stock's performance is minimized. This diversification makes index funds a relatively lower-risk investment option, especially for those seeking steady long-term growth. Time commitment passive investing with index funds. Another crucial factor to consider is the time commitment required for each investment approach. Investing in index funds is often referred to as passive investing. This is because once you've chosen an index fund that aligns with your investment goals, it requires minimal monitoring or adjustments. Index funds are inherently diversified, and their composition is managed by fund managers, relieving you from the burden of constant monitoring. This passive approach makes index funds an attractive option for beginners or individuals with limited time to dedicate to managing their investments. Effort and research active stock picking. In contrast to the passive approach of index funds, investing in individual stocks requires a more active role. Successfully picking individual stocks that outperform the market necessitates significant research, analysis, and ongoing monitoring. You need to understand the company's financials, industry dynamics, competitive landscape, and future growth prospects. This level of due diligence requires time, effort, and a certain level of financial literacy. For beginners, dedicating the necessary time and effort to actively manage a portfolio of individual stocks can be challenging and potentially lead to costly mistakes. Potential returns, long-term growth with index funds. Now, let's delve into the potential returns of both investment avenues. Historically, index funds have demonstrated consistent and competitive returns over the long term. While they may not offer the explosive growth potential of individual stocks, their steady performance, coupled with their lower risk profile, makes them a reliable option for building wealth gradually. The power of compounding, where your returns generate further returns over time, plays a significant role in the long-term growth potential of index funds. Stock picking: high risk, high reward. Individual stocks, while carrying higher risks, also hold the potential for higher returns compared to index funds. If you can identify undervalued companies poised for significant growth, investing in their stocks can yield substantial profits. However, this potential for high rewards comes with a higher risk of losses, especially for those lacking experience and in-depth market knowledge. It's crucial to remember that stock picking is not a guaranteed path to riches. It requires careful research, due diligence, and a bit of luck to consistently pick winners. A balanced approach. Index funds as a foundation. So, which investment avenue is better for beginners? For most beginners, starting with index funds as the foundation of their investment portfolio is a prudent approach. Index funds offer diversification, lower volatility, and require minimal time commitment, making them ideal for building a solid financial base. As you gain experience and confidence in your investment knowledge, you can gradually explore individual stocks. Starting with a smaller allocation towards individual stocks allows you to learn the ropes of stock picking without exposing a significant portion of your capital to high risks. Conclusion: start small, grow steadily. Investing is a journey, not a destination. It's about making informed decisions that align with your financial goals, risk tolerance, and time commitment. For beginners, starting with index funds provides a solid foundation for building long-term wealth. As you gain experience, you can gradually incorporate individual stocks into your portfolio. Remember, the most important step is to start investing early and consistently. Even small contributions invested wisely can grow significantly over time, paving the way for a secure and prosperous financial future. Like and subscribe for more financial tips.